Hi believers, this is Brijesh from Waya. In the month of February, Nifty couldn't maintain the support range of 22,900 to 23,000 and is now sharply heading towards the lower support zone of 21,800 to 22,000. For the first time in 29 years, major indices have experienced 6 consecutive months of downward movement. The following chart illustrates the performance of broader and sectoral indices for the month of February. As you can see in the chart, small caps and IT stocks were the worst hit sectors, while metals were the only sector that was positive in the month of February. Banks and NBFCs have shown enough resilience, with BankX just down 1.2%, while BSE 500 has lost 7.85% in the month of February. The outperformance of sectors relative to BSE 500 indicates that the metals, banks, and NBFCs should lead when a bounce is witnessed. If we take a look at the chart of the Nifty, it's evident that index will test the 21,800 support level in coming sessions. Momentum oscillators are extremely oversold, so a short-term bounce is possible once the support range is tested. A breach and close above the 23,000 is necessary to confirm that a short-term bottom is in place. The lower support is placed around 21,200 levels, which in fact coincides with the election results day low. Banks have been very resilient, as seen in the chart, where Bank Nifty has not breached below the January lows. Upside resistance is placed in the range of 50,000 to 50,200. So far, 48 to 48,200 range has acted as a strong support, and a breach below brings in play the low of election day results, that is around 46,000 levels. There has been considerable discussion about FI outflows, and the crucial question remains when we can expect the outflows to cease. At Waya, we have conducted a comparative study on this matter. The study indicates that once a short-term peak is established for the USD INR pair, the following 3 months have seen significant FI inflows into Indian equities, that is visible in red bars. The blue bars represent the total FI inflows during the entire downtrend of the USD INR pair. The USD INR peaked in March 2009, and the subsequent 3 months saw inflows of approximately 20,000 crores. Likewise, the USD INR reached its peak in August 2013, and the next 3 months witnessed around 36,000 crores of FI inflows. Historically, every time the USD INR has peaked, FI inflows in the subsequent months has been substantial. Let's take a look at the USD INR chart and what it says. Geometric pattern analysis of the USD INR pair suggests that the short-term target for the pair is around 89 levels, and that is around 2% further depreciation from here. Once the target is achieved, we expect a sideways corrective pattern to unfold in short term. A leading indicator of a market top will be reduced FI selling as USD INR approaches 89 levels. So what went wrong with the Indian equity markets? After Indian general elections, CAPEC gave way to subsidies. In effort to save the depreciation in INR, RBI ended up tightening liquidity too far. INR was overvalued and the markets too were overvalued. That gave a perfect exit point to FIs. So in all, fiscal tightening plus wrong kind of spending plus monetary tightening to support currency contributed to the slowdown of the Indian economy. So what's the conclusion? Valuations are no more expensive for equities. However, the USD INR is yet to establish its short-term top. We expect FI selling to dry up in coming weeks and markets should stabilize soon. Out of 20 economic leading indicators, 16 are showing positive signals in the month of January, compared to only 8 in December. We expect strong economic recovery in fourth quarter of FY 24-25. At Waya, we make our best efforts to keep you informed about markets through our weekly bites and monthly sectoral update. Thank you and good night.